This is the Doc and Eric Dubin with the SD Weekly Metals and Markets Wrap. Joining us today is a special guest that we've wanted to have on the show for quite some time, Gold Money's James Turk. James, it's great to have you with us today.
Thanks, John. It's always great to be with you.
All right, well, let's start right off here in the gold and silver markets. We both had a really big bullish week last week. Both climbed above the 200-day moving averages, and as Eric predicted in last week's show, both gold and silver have been taken down a bit here this week. I guess let's start off with your overall take on gold and silver here as we are closing in on the end of the first half of 2015, James.
Yeah, okay. We have resistance at 1225 on silver, on gold, and maybe in the 1725 to 1750 area on silver. And we've been knocking up against those areas ever since we broke below those levels back in March. And I think it's like this is the sixth time that we've been trying to, break through 1225 on gold. Eventually, with this base that we've been building over the last couple of years, we will break through it. We know all of the reasons as to why gold is eventually going to go higher. But, there is a bit of a wall there. Probably, the guys who don't want gold to go higher are in there selling a lot of paper. But on the other side, you got a lot of people buying physical, and that's why, gold is stuck in this range. When it dips below 1,200, the physical demand comes in. When it goes up to 1,225, the paper shorts start selling, and we've seen it again just recently. We have to remember that, just a few weeks ago, gold was a lot lower. We were back well into the mid 1100s, and silver was briefly under $16. So, the fact that we've come up so much over the past few weeks, it's not unexpected to see a little bit of a breathing space. But I think you could sort of say that gold and silver are consolidating, and I think the gold and silver are going to be very soon ready to probe again 1225 and finally break above this resistance in the mid 1700s in silver. That's the hurdle we have to get through. There are additional hurdles further on because the shorts will keep on drawing lines in the sand. But as long as the physical demand remains brusque and it is still strong, the price of the precious metals are going to go higher. So yeah, it's breathing space this week, but I think by next week we're going to be again probing above 1225, and let's see whether we can finally break above it.
As you touched on the demand, James, and as you mentioned, the physical demand has remained extremely strong. Maybe not quite the levels we saw at some of the peaks, like say last October, November, and the spring of maybe 2013. What are you guys seeing at Gold Money with some larger investors right now, maybe compared to some of those times?
Yeah, it's been fairly consistent. We've been seeing, good numbers. And one of the things that I look at is here in London, I compare the spot price versus the near-term future or the near-term forward. In other words, what the price is today if you want delivery right away versus what the price is if you want delivery in 2 or 3 weeks. And this is both for gold and silver. And since basically January 2013, the spot price has been higher than the price in the near forward or the near future. It's a situation called backwardation. It's not supposed to happen in theory. It only happens when the market is in an extreme situation, that the demand for physical is just overpowering the available physical supply, and people don't want to wait to 2 or 3 weeks and get a better, lower price. The other thing that happens when you see these backwardations, people who own physical metal aren't enticed to part with their physical metal, profit from the arbitrage by buying back their metal at some future price. And not only do they buy back in the future at a lower price, they also avoid the storage charges during that period of time, and they have the use of the proceeds when they sold the metal in the physical market on day one. So the issue here is that nobody's taking that arbitrage because nobody wants the counterparty risk. They're worried about whether they are going to get their physical metal 3 or 4 weeks in the future because of the tight conditions that are prevailing. John, as well as I have, that the past 2 years or even a little bit longer, the market has been dominated by these huge flows of physical metal from the west to the east. It's not as high as it was at periods of time in the past, but it's still very strong. And there's a difference between the paper market and the physical market in the sense that the physical market, these guys are patient. They're not going to chase on the upside, although that might change if Greece blows up or we have some unexpected black swan event occurring where people rush out of paper and into physical. But they just think that, well, I'm going to continue accumulating physical metal because it's undervalued. And every time it dips below 1,200, you see a huge surge in physical metal again. The shorts can't sustain those prices, and consequently the metal bounces back up.
You had just mentioned Greece, and I think it's an apropos topic given the latest cycle that we're in now with walls between the Troika and Greece. Earlier, I guess about maybe 6 weeks ago or so, you had speculated that if the Greek banking system sustained ongoing withdrawals from customers to the point where the line between reserves versus the amount that the Greek economy owes to the Troika were to cross, that would put the ECB and other creditors in a precarious position, kind of like what happened with Cyprus, where that line was indeed approached, and that's when the bail-ins happened. A lot of things have happened since you spoke about that. For starters, the Greek government raided some pension funds, and last week we had the craziness of the Greek government taking IMF SDR loans that they were to receive the following month and pledging their current SDR payments to the IMF with that same funding. So kind of like taking money out of one pocket and paying off a debt by placing it into the other pocket to back up a loan. When it comes to that thesis you initially thought of and posited a few weeks back, where do you think we are now? Do you think that you'd look at that slightly differently now, and how do you see this whole crisis with Greece unfolding?
Yeah, if 6 weeks ago I said that Greece was going to be collapsing in 2 months, people wouldn't have paid attention. I put a warning sign out there purposefully so that people would know that the writing is on the wall. It wasn't necessarily to pinpoint the accuracy whether those two lines would cross, within 2 weeks or 2 months or even possibly 4 months. It's
right.
basically I was trying to communicate that the situation in Greece is very precarious because what you have is a continuing withdrawal of deposits from the Greek banking system. A few years ago there was 250 billion on deposit in the Greek banking system. Today there's probably less than 130 billion on deposit in the Greek banking system. A few years ago, the ECB's credit exposure to Greece was probably in the area, off the top of my head, maybe 30 or 40 billion euros. Today, it's about 112 billion euros. So what's been happening is, as those deposits have been pulled out of the Greek banking system, the Greek banks have turned to the ECB and said, give me the euros so that they don't have to call these loans. And the reason why they're not calling the loans, some of them are term loans, a 3 or 5 year loan, and the borrower cannot actually have the loan called away from him by the bank. But the other thing is that a lot of those loans that the Greek banks have made are never going to be repaid because the Greek economy is so poor that a lot of loans made in the good times are always written off by the banks in the bad times. Those banks have not yet come to understand or come to recognize or have not publicly willingly admitted how bad some of those loan portfolios are. So it was sort of a trumpet call to say, look, Greece is potentially here going to do the same thing as Cyprus, and I think that's where we're headed. We're much closer to it now than we were, just a few weeks ago. Every Wednesday, basically, the European Central Bank increases the amount of credit exposure it has to Greece by increasing the line of credit by which Greek banks can borrow from the ECB. It's called the ELA, Emergency Liquidity Assistance. And every week, deposits are being pulled out of the Greek banking system. So it seems to me inevitable, unless there's some fundamental change, you're going to see a bail-in in Greece. The only thing that the European Central Bank could do is accept that the $112 billion euro exposure it has to Greece is never going to be repaid, and distribute that paper to the national central banks. Where the national central bank's going to get the money, they're going to put it on the back of taxpayers in each of the remaining members of the Eurozone where they each take their pro rata share. Politically, I just don't see that as a feasible alternative. That's why I think the only thing that is going to happen is eventually when those two lines cross, the ECB exposure going up and deposits in the Greek banking system going down, you're going to see a Cyprus bail-in by the ECB. They're going to take the deposits out of the Greek banks and use those deposits to repay the loans that the ECB has made. And the paper that is on the ECB books now is going to go into the banking system in Greece, which will make it even more insolvent than it already is.
James, along that lines, what happens next if that does happen and we do see a Cyprus-style bail-in in Greece? How long does that take for the rest of the southern European nations, the pigs, Portugal, Italy, Spain? How long until we see bank runs and people pulling assets out of their banks, recognizing that they might not be far behind?
You're asking exactly the right question, and it's unfortunately something we can't predict. But, when Greece gets bailed in, like Cyprus was bailed in, everybody in Italy and Spain are going to be scratching their head and say, good Lord, what country is next? I read something in the Financial Times a few weeks ago that 17% of the loans in the Italian banking system are non-performing. In other words, they're not meeting the terms and conditions for which the original loan was granted. Not all of them are going to be written off, of course, but that's far greater than the amount of equity in the Italian banking system. So, is it going to be the Italian banks are going to be next after Greece, or is it going to be another small nation, like perhaps Slovenia, which has also been dealing with debt problems and a stagnant economy as well? Or is it going to be, one of the bigger countries? We just can't predict it. But that's absolutely the right question to ask, because that's what everybody in Europe is going to be thinking. And it may not be the third country that eventually brings the system down, or even the fourth country that brings the system down. But there's something more fundamental happening here that, all of us have to really question ourselves. And it relates to an article I wrote back in 2009, commenting upon the the first indications that there was a problem in Greece. And the title to the article, and you can still find it on the internet, was something to the effect, will the crisis in Greece bring a collapse of socialism, or the end of socialism? Because in that article I quoted Margaret Thatcher and said the problem with socialism is that you eventually run out of other people's money. And that's what's happened in Greece. There are too many people living off of the government and government promises, as opposed to creating the wealth that was necessary to service the huge mountain of debt that previous governments in Greece had put on the back as a burden of the Greek citizens. So we're going to come to a reconciliation here, and it may not be this month or this year even, but it's definitely coming. That the question that fundamentally is going to be asked is, how far can these Western governments with the huge social burdens continue to go with this existing system? I mean, the only reason why we have zero interest rates is because governments can't afford to pay a fair rate of interest. Using the U.S. government as an example, you've got $18 trillion of debt. If interest rates went up 1%, that's $180 billion a year. If they went up to a fair rate of 5 or 6%, we're talking about $1 trillion a year. The government only has $3 trillion of revenue. They're not going to cut back in spending in the other areas in order to pay interest. So that means they'd have to borrow more and have even bigger deficits than the government is now running. And bigger deficits basically mean higher interest rates, and you get into a vicious cycle, and that ultimately leads to hyperinflation and the destruction of the currency. So I'm still of the view that fiat currency, this experiment that started in 1971, is coming to a conclusion. You just can't predict, when we go over the cliff. And to avoid going over the cliff with everybody else who's, believing in government promises that the problems can be solved, to avoid going over that cliff, you have to own physical gold and or physical silver. With physical gold and physical silver, you don't have any counterparty risk. You don't want to be dependent upon other people's promises. And that's, over 5,000 years of history of gold and silver as money. That's the message that we can take from monetary history. Gold and silver survive. A lot of other things don't.
Yeah, you frequently mentioned that hyperinflation is basically a confidence event when it comes to currency, and there's always been a debate as to whether or not we're going to see a period of deflation or hyperinflation or more high-level inflation leading to something catastrophic like hyperinflation on a going-forward basis. And your point about the confidence is really important, because even if we are to see a deflationary spiral come on the back of something in the financial markets that kicks off a domino collapse in derivatives that spills over to asset price and deflation and spilling over even into the real economy with deflationary forces like 2008, the final game plan most likely would be in central banks around the world doing some kind of a monetary reset, maybe resetting their balance sheets to a much higher price of gold and taking the monetary systems of the world onto a gold standard or some quasi-gold standard or some other flavor therein. And I was wondering if you could speculate on all of those dynamics as we move through 2015 with the Chinese looking to get representation on the SDR basket and maybe even having gold that's 10% weighting or whatever. 10% has been spoken about in policy papers and whatnot, as perhaps maybe a catalyst along the road of the evolution that we're going to transverse in this coming year and beyond. And obviously this is just me asking you to speculate, but what do you think might be the higher probability end game that we might see in the months and years ahead?
Governments are going to come back to gold either logically and willingly, or they're going to come back kicking and screaming because market forces demand it. Which of those two alternatives it will be, I really don't know. But we're sort of seeing, you brought up the point about confidence, and I think this is really important, because we talk about the supply of money, but very rarely do we talk about the demand for money. But the demand for money is basically falling. It's hard to measure, but you can only look at anecdotal pieces of evidence. The Austrian School of Economics, they basically have this, Ludwig von Mises came up with this term, a crack-up boom, where people lose confidence in the currency, the demand for the currency falls, prices go up as a consequence because the supply is there, and money has a supply and demand just like anything else. So if supply remains constant and demand falls, the price is going to go up, which expressed in terms of money means that it will have less purchasing power when you go into the marketplace and buy the goods and services that you need to live. So, yeah, we're seeing a demand for fiat currency decline, but it's sort of interesting. It's not yet going into physical metal, at least in the West. It's obviously going into physical metal in the East. But here in the West, the people with big bucks are taking money out of the banking system and they're putting it in things like art or automobiles or even real estate. But the logic is the same. They're buying things instead of buying promises. When you own a Monet or whatever it was that just went recently for $200 million, I mean, you own a one-of-a-kind type of thing, and that's going to be that Monet or Van Gogh or whoever the artist was, 20 years from now or 100 years from now. So the very, very wealthy are thinking, how do I preserve my wealth in a world of crazy monetary policies by, being pursued by central banks? Because you're not going to preserve your wealth by putting money on deposit in the banking system when they don't pay you any money that keeps up with the inflation rate or is adjusted for the risk that you have by accepting the counterparty risk when you put money in a bank. So, money's being pulled out of banks worldwide and being put into things rather than being put into, economic activity that would create jobs. And the reason why that's happening is because governments around the world are creating too many taxes. I guess what I'm saying, just sort of thinking about it as we're chatting, capitalism is being destroyed around the world. Mises had a comment, and sort of to paraphrase him, it says, governments will destroy capitalism long before they ever understand how it works. And I think we're seeing that happen now. And it's a very scary situation. As individuals try to plan for themselves and their family with an unpredictable and uncertain future, what do? I think the answer is, you buy things, avoid promises.
It's a gigantic malinvestment. I think the kind of skewing of markets that is going on now has ever happened in humanity at the scale worldwide. It's quite astounding to see even savers have a war on themselves, and banks are now beginning to charge for deposits. And in fact, there's talk of making cash outlawed, moving people into an electronic system for better efficiency of taxation and tracking and so forth. What do you think about the recent talk of a cashless society worldwide? I mean, it definitely is a meme that is being discussed frequently by intellectuals and policymakers and the media at large.
It's pretty scary. I mean, they're putting tracking chips in cars and passports and everything else. When are they going to want to try putting tracking chips in people? I mean, that's the trend, and it's very, very scary. I mean, freedom is being eroded worldwide, and a lot of people are accepting that for a variety of different reasons, but it is very, very scary. And my hope is that, when that big black swan finally hits, and the monetary system goes through an earthquake, let's call it, that we will wake up and that we will go in the right direction once again. I'm hopeful that will happen, but who knows what's going to happen. Maybe there'll be more capital controls and more reasons for worry and concern. But again, I still come back to the basic premise that even if the banks collapse or the monetary system collapses, if you own a piece of farmland, that farmland is going to produce food for you regardless what's happening 20 years from now. If you own a timberland, that timberland is going to produce wood 20 years from now regardless what happens to the monetary system. This is something I learned from my parents, them having gone through the Great Depression. I was born in 1947, so I'm 68 this year. Obviously, I didn't live through the Great Depression, but it was very much fresh in their minds when I was growing up as a kid. And so, I would learn from them their experiences. And one of the things that stuck with me is that a lot of people who had financial wealth in the Great Depression, be it money in a bank deposit or an insurance policy or any kind of promise, whatever it happened to be, they ended up doing poorly. But anybody who had any kind of tangible wealth that could generate cash or produce wealth, like farmland, or companies that survived because they produced products that people wanted regardless of the economic conditions, or of course gold and silver, physical gold and physical silver, they did okay. They managed to get through. So I keep coming back to this basic premise. Think in terms of things rather than promises. Think in terms of tangible assets rather than financial assets. That's the best way to get through any tough times that we have ahead. And if, let's say I'm wrong, let's say, the governments continue to muddle through for the next, 5, 10 years or whatever. There's no downside by owning tangible assets, in the sense that, farms will continue to produce food, mines will continue to produce whatever they produce, gold, silver, iron ore, copper, whatever. And these are things that people will continue to need. So think in terms of tangible assets is, I guess, really my theme for today.
Yeah, it's a very good hedge. You also have spoken about how high net worth individuals and sovereign wealth funds and others have periodically taken an interest below 5% in a typical Fortune 500 stock, like an Exxon or something that is a natural resource-based producer, yet at the same time could theoretically have the ability to transition through to some kind of a new monetary system if we were to have that kind of a crisis. Do you still think that that's a good addition to people's hedging to, and in particular, have the stock certificates outside of street name such that it's outside of the banking system?
Yeah, I'm not a specialist in terms of how to get certificates outside the banking system, and but there is a risk there if you leave it with a broker. But we have to ask ourselves, why is the Dow Jones or the S&P 500, breaking record after record? It's not because of the good economy in the United States. It's because of all of this money printing that's going on around the world, and people are in there buying things, that own real assets, and there's a lot of dumb money going in there too, because there's a lot of money still going into the financial sector of the stock market. But the market will wake up eventually as the monetary problems become more apparent, and as we go through another 2008. The market, as they say, it's not a stock market, but rather a market of stocks. And those stocks that are related to tangible assets, I think, will continue to plow higher. But those stocks related to financial assets like banks, insurance companies, mortgage companies, credit card companies, and the like, those stocks will, separate from the general trend of the tangible stocks and either go sideways or maybe even go down.
Most of the regular financial world still thinks that central bankers have their back when it comes to making those investments. And for the time being, they do.
Yeah, well, that's what makes the market. You have to prepare for what's coming rather than what has been. But unfortunately, it's very difficult to think ahead. And how do you plan for an uncertain future, or how do you plan for a world where you can't predict what's going to happen? It's a tough situation, and it's not easy to do.
So we've spoken a number of times with Alistair McLeod, who is your at Gold Money, the research director, and he's done some fantastic work when it comes to trying to ferret out how much gold China may in fact have. It's far above 1,054 metric tons as they last declared in 2009. And he's worked out a number that could be as high as 20,000 metric tons. What do you think about China's gold holdings now, and where do you suspect they stand when it comes to the volume they hold?
Yeah, just to clarify that point, the 20,000 plus number that Alistair was talking about was all of China, both public sector and private sector.
Right.
The 1,400 or whatever the number is, that's 54. Just been reported by the PBOC, the People's Bank of China, as to what they own. That's the official reserve. First of all, dealing with the official reserve, I think they own a lot more than that. They don't report accurately to the IMF how much they own because they see gold as something that they can use to their political advantage when they make their announcements. If they're unhappy with U.S. government policy, I think you'll tend to find, looking at the last two announcements, an increase in China's gold reserves being reported. What we've got coming this year is a very important event, which is the rebalancing of the SDR, the currency of the IMF. The Chinese yuan is not in that now, and for the last 5 years, because the rebalancing comes every 5 years, China has been working toward being included in the SDR, and one element of that was accumulating more gold. So I think you're going to see a gold announcement this year, and I wouldn't be surprised to see China announce that they have maybe 3,000 tons of gold, or maybe even a little bit more, maybe 3,500. So they're the second biggest gold reported hold of central banks, bigger even than the current number two, which is Germany. With regard to the Alistair's number on the 20,000 tons or more, we have to go back and think. But back in the 1980s, the 1990s, in the 80s we were producing 1,800 tons of gold a year. The 90s we were producing over 2,000 tons of gold a year. In the first part of this century, we were producing 2,500 tons of gold a year. Now we're starting to approach 3,000 tons of gold a year. So you've got 30 years or more of gold being produced. So we've got maybe 40,000, 50,000 tons produced over this past 30 years, increasing the gold stock from say 120,000 tons to maybe 170,000 tons today. Well, where has that 40,000 tons or 50,000 tons ended up? Well, we know a lot of it has ended up in India, but only part of that amount has ended up in India. What's happened to the rest of it? Well, some of it's gone into coins in the West, but a lot of that coinage has been disappeared. Some of it's gone into central banks, but a lot has come out from central banks as well. So, I think what Alistair was, I'm not trying to put words in his mouth, but I think what Alistair was saying, that there's a lot of gold there unaccounted for, and the logical conclusion is that China had been scooping it up, first in the private, the PBOC level, at government levels, through the central bank and through their foreign currency fund, and then they opened it up to the public, and we know the public's been scooping up that metal as well. So I think Alistair's assessment is accurate. I think there is a lot of gold in China, and there's an old saying, money is power, gold is money. So, the power goes where the gold goes. And I think you're going to see a lot more flexing of muscles by China, and rightly so, as it becomes a major player in world economic activity, rankings versus other countries. It's not to say that China doesn't have problems. They have some big ones. There's been a lot of credit created over there. There's been some malinvestment and a variety of different things. But net, there's also a lot of wealth being created over there, and people who have been creating wealth have been preserving it and protecting it by buying physical metal.
You mentioned India, and I'd really love your opinion as to whether or not you think the government is going to be successful in cajoling temples to get their paper in exchange for their gold and maybe getting some interest in return, as well as private citizens in the scheme that they're trying to whip up to get people to deposit gold into banks in exchange for gold certificates and actually payment of interest. I mean, Warren Buffett would be surprised. You don't just bury it in a vault underground. You actually get paid for interest if the people in India's policy establishment are going to be successful in doing this program. Just, I believe it was yesterday, Bloomberg published a story. Sorry, it was Reuters, now that I recall, that spoke about how a lot of the banks in India are concerned about this program because, frankly, they don't have the reserves to start paying interest on this hoard of gold that could possibly come into their system. Do you think the Indian government is going to be successful in trying to pull gold into the official establishment so that there's more gold available to dump on public markets and deal with their current account fears and the devaluation of the rupee as people buy more gold on the international markets?
Yeah, you're asking a difficult question because I'm not a sociologist and I don't understand the psyche of the Indian people. But my view of it is that the government in India is making these pronouncements more for propaganda rather than any expectation that they're going to convince the average Indian that the little bit of gold that they've saved and accumulated should be transferred for paper. I've spoken to a number of people over the years to try to better understand, why people are buying gold in India. And even, the poorest farmer in the most remote regions understands that the price of gold in Indian rupees in the 1960s, I don't remember the exact numbers, but it's something like it's gone from 260 rupees an ounce to 60,000 rupees an ounce, ballpark numbers. And in that kind of environment, why would anybody want to own rupees or any kind of promise instead of gold? Gold can be, and money generally, can be spent or it can be saved. The average Indian farmer understands that saving any wealth he's managing to accumulate, saving it in gold is advantageous because it preserves purchasing power, and then he can do what most families want to do. They want to accumulate that wealth and pass it on to the next generation so that the next generation has a higher standard of living than the parents did. And, that's been the march of progress in Western civilization for hundreds of years. But with the monetary problems that we're facing today, a lot of people are questioning, is the next generation going to be as well off as the current generation? Well, if you own gold, I think you are. But if you own promises and paper, I think one is taking an undue amount of risk, and that maybe the next generation, if you're reliant on paper and promises, won't be as well off as the current generation.
Yeah, and I think you're right on the propaganda point. I think somewhere in the neighborhood about 1/3 of the gold purchased in India is for dowries for brides, and paper certificates don't look particularly well hanging on a bride's neck.
Yeah, no, that's absolutely right. You bring up an interesting point that a lot of people don't understand. When the World Gold Council and all of these other groups talk about, jewelry demand is this or jewelry demand is that, they don't distinguish between two types of jewelry demand. There's jewelry for adornment and there's jewelry because it's money. Now, in the West, when we buy gold for monetary reasons, we buy it in the forms of coins and bars. But in the Middle East, Asia, people, because of historical, traditional, cultural reasons, when they buy gold for money, they don't buy it fabricated as a coin or a bar. They buy it fabricated as a form of jewelry. And if you actually calculated how much jewelry demand was each year, it far outweighs any adornment jewelry And it's just looking at it logically. You know, the thing that an Indian bride has around her neck or around her wrist, it's either 22 or 24 karat gold. But in the West, if you buy a wedding ring, it's very often 9 karat gold, which means there's hardly any gold in it at all. So, you know, you have to look at the different reasons why gold is being bought. And in India, it's being bought because it's money. It just happens to be fabricated in a form different from the way it's fabricated in the West.
One final question for you, James. At least here in the West and the U.S., retail investment sentiment in gold and silver markets is the lowest we've seen in years, probably comparable at least to the early 2000s. What's your take of the current opportunity to acquire physical gold and silver, say around 1,200 in gold and let's just say 17 in silver, versus back 15 years ago we were looking at maybe say $300-400 gold, $5-6 an ounce silver? I mean, I personally think you could make an argument that there's better opportunity. It's a better time now than back then. Is my personal thought. So I'd like to get your thoughts on that before we close here.
I'll go even further than that. Buying gold today at $1,200 is even better than buying gold at $35 an ounce back in 1971. That's how cheap gold is today. The reason why it's so much higher in nominal price is simply because of the destruction of paper currencies by central bank policies that have destroyed purchasing power of those currencies. So, yeah, it's cheap today. But what I always recommend, John, is forget the price. View gold as a form of savings. Every month, whatever you manage to accumulate and save in that month, buy some physical gold, buy some physical silver, put it away. Next month, regardless of the price, buy some physical gold, some physical silver, put it away. Those are your savings. It doesn't make sense to save paper currency anymore. It does make sense to save physical gold and physical silver. And if you ignore the price, and this is hard to do because, you know, we read in the paper that, you know, gold's up $20 or it's down $20, just have the discipline on a certain day of the month, at the end of the month after you've got money left over in your family budget. Just put that money into physical gold and physical silver. It's been a policy that's rewarded not only people in India, but also people in the West who've had the discipline to follow it and recognize gold as a form of savings. And that's been my policy since starting Gold Money back in 2001. It continues to be my policy today. It's not easy for people to do it because, you know, if your broker's telling you one thing, or you read in the newspaper, or your brother-in-law says something else, emotionally it's hard to detach yourself. When you're getting involved with money and you're buying something that's out of favor. But, you know, just think about gold's 5,000 years of history and how it's always protected people who have accumulated. If you look at it that way instead of looking at the price, I think you'll be happy.
If I can ask you just one more question, indulge you, and you're very generous with your time. You were one of the very first people who developed through Gold Money the possibility of doing direct transactions through kind of like a credit card system through Gold Money, and ultimately the regulation quagmire in the United States made you turn away from that. But you have a lot of insight in that developing market, and probably have insight in how you'd reflect on how Bitcoin and alternative currencies in general might play a role in the weeks and years ahead. What do you think as far as the viability of a system like that in some future date when maybe governments were to be on possibly a gold standard just because of monetary turmoil or just in general? How do you see that emerging market unfold?
Yeah. To answer this question, I'd like to make the point that money and currency are two different things. We use the two words interchangeably because in the past few decades we've lost sight of the different roles they play. You know, money can be basically anything. It's a what I call a mental tool that we use for economic calculation. It enables us to interact with other people in the marketplace. But currency is different. Currency is what we actually use once we've completed our economic calculation. So, for example, let's say I want to make a trip for a holiday, and I can actually pay for that trip in terms of any number of different currencies. But I did my economic calculation in terms of, well, okay, it's going to be X amount. Do I have that money in my budget? And, do I have that money saved up to make that holiday? And how do I pay for it? If I'm going to Brazil, well, maybe I'm going to pay for that in Brazilian cruzeiros or whatever the currency is down there these days, reals, I can't remember now, rather than British pounds where I live. But so you have to distinguish between money and currency. Money, as this mental tool, does the same thing today it did 100 years ago, 500 years ago, 1,000 years ago. It enables us to calculate value of goods and services when we go into the marketplace to fulfill our needs or wants. We use currency in the marketplace. And now here's the important point to answer your question. Money doesn't change, but currency does change. Currency evolves over time. It becomes more and more efficient. And all of these movements toward alternative currencies is a natural occurrence because the currency that we're using today comes with very high costs. It comes with counterparty risk. It comes with the anywhere from 1.5% to 7% that a merchant is paying to the credit card company. It comes with bank wire transfer fees and all kinds of things like that. And whenever you attach a lot of expense to a currency or a lot of difficulty to a currency, it cuts down the opportunities for commerce. You want to remove impediments so that more people can interact with one another in commerce. And when you do that, people create wealth and everyone's standards of living rise. Again, this is the key to capitalism. So what we're seeing today is that we live in a different world because of the technology that we have available in terms of communication. I'm here in the United Kingdom. You guys are, I guess, in the United States. We're talking as if you were in the same room with me. Not too many years ago, that wasn't possible. And the Internet has opened up a whole new opportunity of commerce. We need a currency on the Internet that moves around efficiently, at low cost, and with little risk to the people who are spending it or accepting it. And we're playing around with a lot of different ideas and a lot of different things, and we have been doing this for 15, 20 years, ever since the Internet first came up. Remember all of these cash ideas for cash on the Internet, back in the late 1990s. They've all gone by the wayside because they just weren't practical or reasonable. But the technology that we have today is going to change things. It may not change tomorrow or next month or even next year, but eventually the market will decide upon a new type of currency. And in this regard, I think cryptocurrencies have a very important role to play in the future. It's still early days, just like the Internet was early days in the early 1990s, but eventually it became mainstream, and I think cryptocurrencies are going to become mainstream as well. It seems to me just inevitable. It's just a question of time and watching and waiting and see how it develops.
All right, well, speaking of time, we'll wrap up the show there. We've been able to pick your brain for quite a while, and we're quite appreciative. So, James, thanks for joining us today.
Well, it's been a real pleasure talking to you, and let's do it again in the future sometime.
Yes, and before you go, I do want to put in a plug for your outstanding books that you've written with John Rubino. About a decade ago, you released The Collapse of the Dollar and How to Profit from It, Making a Fortune by Investing in Gold and Other Hard Assets. That was a great formative book. I mean, I found it very eye-opening and very insightful in terms of what goes on with currencies and governments as they get pushed up against the wall from debt crisis and other problems. And most recently, last year, you released The Money Bubble, also co-authored with John Rubino. Outstanding books. I'd highly recommend them. They're available on Amazon. And a couple of years ago, you announced that you were retiring from gold money. And when I heard that, my heart sighed, because you've been a touchstone for people who seek to understand what's going on with our economic systems and money in particular. And I'm very happy to have had the opportunity to continue to hear you do interviews and that you're still out there in the public. It's just that you didn't step down from goldmoney.com and
well, thank you. Thank you very much, Eric. I retired from the day-to-day. I'm still on the board of Gold Money, and because it's been such an important part of my life for many, many years, even before I founded it. When I was first developing the ideas. I don't think I'm ever going to completely retire. What I have done is I've cut back a lot on the travel and speaking at conferences, but I still like to speak to old friends like you guys. So as long as God keeps me on the surface of the earth, I'm happy to do interviews every once in a while.
I hope you have many decades to come.
Thank you very much.
All right. Gold Money's James Turk. For the Doc and Eric Dubin, thanks for tuning in to this week's SD Weekly Metals and Markets.